Hello, welcome to this Ned Davis Research vodcast, where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we'll be speaking with NDR's Chief Economist, Alejandra Grindal, about her 2025 second half outlook regarding the global economy. Alejandra, are there key themes from the first half of the year that are carrying over to the second half?
Great. Thank you so much for having me, Ryan. So I think the obvious theme of the first half that will continue into the second half is policy uncertainty. It's been the key influence so far in 2025. And most of the major economies that we monitor, so we tend to focus on the G7 and the big economies, the largest economies in the world, will likely see slower economic growth in the second half of this year, just due to the impact of tariffs and policy uncertainty. Now, fortunately, recession doesn't appear on the horizon anywhere, with the exception of Japan, where recessions are just a little more common given the economy's very low potential growth. Among major economies, we are the most optimistic about growth prospects in the Eurozone and India due to domestic monetary and fiscal support. Policy uncertainty, however, will have the most adverse impacts in the US, which clearly is where the uncertainty is rooted, as well as Canada, which has close ties to the US economy. China so far is only showing modest signs of slowing, but more fiscal support will be needed in order for the economy to reach the government's growth goal. Brazil, on the other hand, is somewhat shielded from US tariffs. However, domestically, it's facing high inflation, extremely tight monetary policy, and that will slow the expansion in that economy.
Why do you think the US economy is slowing, but not falling into recession at this time?
That's a great question. So at NDR, as you know, Brian, we're known for watching the data. And we like to stay disciplined, and often we resort to our watch reports as a guide. So in this case, we would resort to our US Recession Watch Report. And currently, we have two indicators in the report giving recessionary signals. Those two indicators are the services PMI and CEO confidence. Now, historically, it's actually not uncommon to have two signals at a given point in time. It doesn't mean that recession's coming. If anything, it's often indicative of slowing economic growth, which is actually our base case for the rest of the year, again, given the heightened uncertainty in tariffs. Typically, we're looking for a majority or 6 of the 10 indicators in the watch report to flash red to make a recession call. And this time around, we're paying special attention to the employment-related indicators. While these indicators, as well as other job-related data we watch closely, have shown some signs of weakening recently, they're still far from their recessionary thresholds, at least for now. Now, the passage of the One Big Beautiful Bill is supposed to sort of shore up some of this tariff and other policy uncertainty and give the economy a bit of a boost to help offset these higher tariffs. And we suspect that the combined impact of tax cuts and tariffs should still provide net stimulus to the economy, but it could also put upside risk to inflation. All else constant, we see a modest lift to our real monetary, fiscal, and exchange rate policy index through 2026. The current level of the index supports moderate economic growth over the near term, which again is our base case for the second half of the year.
Earlier, you mentioned that you were constructive on Europe. Could you elaborate?
Yes, of course. So Europe has had a bad couple of years prior to this year, but it actually kind of started off in a good place at the beginning of this year. Strength in the periphery economies, so these are a lot of the southern economies, are much more, which tend to be more services oriented, had pretty much kept the region afloat and essentially out of recession for the past couple of years. But since the beginning of the year, we've begun to see some budding signs in the Eurozone's core economies, and specifically Germany, the Eurozone's obviously largest economy. So some evidence of data to support this. Our Eurozone recession probability model has a little bit of a leading tendency. It fell in July to its lowest level since November 2021. And then the Eurozone's composite PMI, which is a good monthly GDP proxy, it's shown expansion through June after contracting through most of the second half of last year. And, you know, Yes, there's some exposure from the tariff front, but the prospect of easier monetary policy from the ECB and then a jump in fiscal support from Germany just provide yet another positive element to the outlook.
Finally, what are the prospects for Japan and China?
Yeah, so Japan's economy started on a weak note this year. In fact, real GDP fell an annualized 0.2% in the first quarter. This was the first decline in the year, and this was mostly due to less government spending and net exports. So we've seen some distortions with net exports in general because of the tariffs. But since we continue to have heightened uncertainty with the US, not only with US tariffs on Japan, but also US tariffs on China, which incidentally is Japan's largest trading partner, along with historically high inflation in Japan, Q2 data isn't shaping up to look that much better. So the nowcasting index of economic activity, this is a monthly GDP proxy, it actually fell to a 14-month low in June. As a result, Japan may be heading toward technical recession, which, just regular back of the envelope, 2 consecutive declines in real GDP. But it is worth noting that given Japan's extremely low potential growth, just mostly due to weak demographics, economic declines in the economy actually happen quite often. And we found that historically, they're not quite as much of a dire signal for Japanese equities compared to, say, other economies around the world. As for China, we all know it's been a key focus of US President Trump's trade war, and this is even starting from Trump 1.0 when he had his first term a little bit ago. As of 2024, though, less than, and I think some people are surprised to hear this, less than 3% of China's GDP was reliant on US exports. Not a huge amount, something, but not a huge amount. So it just does suggest some resilience. However, we find just looking at the latest data that more stimulus will be needed for this growth trend to last. So, for example, retail sales so far this year have come in strong due to a government cash for trash program. So we've actually been seeing a big surge in durable goods purchases among Chinese consumers. But as you can assume, durable goods demand is kind of finite at some point. So there's only so many washing machines and microwaves we can buy. So it just suggests that this impulse will fade unless more and broader stimulus is implemented. Looking at the industrial side of the economy, it has shown, contrary to retail sales, a little bit more moderate easing. In fact, industrial production increased 5.8% in May from a year earlier. This is down from a 6.1% pace in April, and it did come in a little less than expected. But incidentally, it's still above the average growth rate from 2024. But similar to retail sales, and the fact that we're still seeing tariff negotiations, I think it would be difficult to maintain that pace without more stimulus.
Alejandra, thank you for your insights. NDR clients can read Alejandra's research notes in her Global Economic Focus publication. The indicators Alejandra and the research team developed for our subscription service are also used in our model portfolios, which are available for direct delivery on TAMPs as well as ETFs. For more information on NDR, we encourage you to visit ndr.com. Also, for those in audio-only mode, video versions, including charts of See the Signals, are available by going to info.ndr.com/ndr-signals. Thank you for joining us as we help you to see the signals. So long.